Hey guys, it's that time of month again for me to do my update on my Vanguard portfolio. I don't know if it's just me, but time seems to be going really fast. I can't believe it's been 4 weeks since my last one, but I'm excited to show you today where my portfolio stands. And also the other amazing thing is that finally my employer pension has transferred over to my SIPP. And I will talk a bit more about that later on in the video as to why I've done that. That finally I have my SIPP with Vanguard, so I'll be sharing my screen and showing you exactly what's in there and what I'm invested in. So if you are an investor like myself, then you probably know the stock market is still not looking pretty right now. So I think it is a good time to really do these portfolio updates. I'm conscious of people thinking that when it comes to investing, you're always going to see lots of green, you're going to always be in the plus, you're always going to be winning. And that is not the reality with investing. There are ups and there are downs. And so I hope these portfolio updates that I'm doing help you to recognize that that is the case. So I do recommend watching this entire video through because I'm going to speak a bit about why I've transferred my employer pension over to my personal SIPP. And I'm also going to speak about some things that you have to be careful of when it comes to SIPPs and transferring from your employer pension. So yeah, basically stick it out because I'm going to discuss some important things in this video that maybe will help you in your own journey. Also, before I share my screen, I just need to take a moment to say thank you so very much for getting me to the point of 1,000 subscribers. I cannot believe it. I am so happy, so honored that I have 1,000 people who have decided to subscribe to my channel to hear what I've got to say. And for me, this is all about just helping people on their journeys. And there's no better help than sometimes seeing someone do it themselves. So I really hope that I can continue to be transparent with you on this channel. And as I learn, I share with you guys what I'm learning. And you know, this is all about financial literacy. Like us all taking responsibility for our own financial literacy and for our own financial futures ultimately. So again, thank you, thank you, thank you. And if you're not already subscribed, then you know what to do. It's literally completely free and you just have to hit that red button down below. And of course, when you like a video, please like it. It's just great for the algorithm and it helps my videos to get out to more people. All right, let's get into this. So we are going to go through one by one. So by now you know exactly what I'm invested in. This isn't changing. And you know, unless I have a change of strategy, I'm probably hoping to stick to this blend that I have right here for the next couple of years. Obviously in my first Vanguard portfolio video that I ever did, I speak about why I've chose these specific funds. So if you haven't seen that, go and check that out. But other than that, this is what I'm sticking to. So obviously my goal weights are still the same. So 50% into the global tracker, which is the FTSE All World, and then 10% to all of the other funds. But as you can see, my current weights are still not dead on to the goal weight, and I always try to balance it out when I put money in each month, but you can never get it perfectly to align. So it's just helpful to have these goal weights so you know where you need to focus on each month when you put money into your portfolio. So for this month, when we get paid, we will put money into the FTSE All World as well as the All World High Dividend. So for the FTSE All World, or the VWRL, it is currently at 3.4%. So, all right, not great. The next one, Pacific Excluding Japan Index Fund, is 9.54. So, you know, as per usual, this is one of my best performing funds. And of course, as I mentioned before, this is one of the ones that I've been investing in the longest. So it's had a bit more time to ride the waves of the market, I guess. The S&P 500 is currently at 6.62%, which is a huge change and jump from last month. Last month, I think it was in the negative. So it's good to see that it's now in the positive and by a fair amount. The FTSE 250 is currently at 4.12%. Again, that's a great improvement since last month. And yeah, I'm quite happy with that overall return. And then for the ESG emerging markets, this one has failed me this month. It's currently at negative 1.94%. So it's not doing great, but it kind of is what it is. And then the FTSE All World High Dividend Yield is currently at 12.5%. So it's actually outperforming my Pacific index fund now. So it's quite interesting that this is doing so well. And again, this was one of the first funds that I had invested in. So it's had more time to be in the positive. But I'm quite happy with that. Overall, looking at all of those, it's a pretty solid return rate overall since inception. So taking the average of this return rate, then my total return rate is 5.71%. So yeah, last month I think it was 4.04%, and so 5.71% is an improvement upon last month, which is great. But again, I didn't expect a huge change because of everything that's going on with the stock market. So tell me what you think. Tell me your thoughts. What's happening with your portfolio? Is it looking similar to mine? Are you in the negatives or are you up? I'd love to hear how you're doing yourself. Right. So now let's go over to my SIPP. I'm so excited about this because honestly, I was getting frustrated with how long it was taking to transfer over. But yeah, it's finally done. So as you can see, my pension value currently is around £15,000, and I am 100% invested in the Target Retirement 2050 fund, accumulation fund. And if you just don't know, accumulation just means that when any dividends are paid out, it gets reinvested. So I don't have to touch it or do anything. So you can see that technically I'm down right now. So I'm down by £11. So, you know, not a great start, but but on the grand scheme of things, it's fine. I don't expect things to automatically be in the up. The good thing about insights on the Vanguard platform is you can see where it's concentrated geographically. So most of this fund is made up in North America, so 43%, followed by United Kingdom at 25%, Europe 12%, and the rest at Asia Pacific 9%, and then it starts to go down from there. So it's just interesting to see. And then you can also see the top 10 investments. So the Vanguard FTSE Developed World, excluding UK, takes up the largest portion, and then the Vanguard US Equity Index Fund, and so on and so forth. And you can also see the sector allocations, so like the financial sector, government bonds, industrials, etc. And basically, the reason why I've chosen the Target Retirement Fund is because I'm happy to take a hands-off approach when it comes to the money in my SIPP. So basically, a Target Retirement Fund is considered a blended fund, and so it's actively managed. So technically, you pay slightly higher fees when you have an actively managed fund. So one thing that I've just realised that I forgot to mention while I was recording, with a actively managed fund or blended fund, such as the Target Retirement Fund that I have, one thing that's really good about it and why you do pay a higher premium, I guess you could say, is because they reallocate the funds as you get closer to your target retirement date. So I have the 2050 Target Retirement Fund, and so as I get closer to 2050, they will do a rebalancing of where my money is invested. Right now, I'll be heavily invested in equities, but as time goes on, I will start to be more invested in bonds, because obviously bonds are technically considered lower risk, and so they automatically will do that rebalancing for you. So you're paying for this, but what it does mean is that you have a more weatherproof type portfolio because they are shifting your allocation as time goes on. The reason why I transferred was simply to do with the fees. So where my employer-based pension is with, their fees were quite a bit higher than with Vanguard. So of course, I'm interested in keeping more money in my pocket and paying less out in fees. So it took me some time to consider whether this was a good idea for me to do. I've done my research and I decided it was something that I wanted to do. First of all, it costs nothing to transfer, which was a big bonus. And second of all, because I already have my ISA with Vanguard, I quite like that I can log on to one platform and see both my stocks and shares ISA and my SIPP all in one. And in doing my research, I realized that I needed to keep at least £1,000 in my employer pension in order to keep it open, keep it active, whatever they consider it. I had to keep at least £1,000 in my employer pension. So So that's what I've done. I've only transferred out enough so that I can keep £1,000 in there. So do make sure that if you're looking to do something similar, that you're aware of what the requirements and restrictions are so that you don't cause any issues. I also checked with my employer if this would impact their contribution to my pension pot, and I didn't really think that it would, but I just wanted to be double, triple sure. And now that I've got it in writing from HR, I just feel more comfortable with doing a transfer. So now I'm going to talk about something quite interesting regarding my plan for my pension as of right now. So as you saw, I've currently got £15,000 in there. It should be more, but it's not more because I actually didn't start working until quite late. It's because I was studying for so many years. So really I would want it to be a lot more than that by the age that I'm at now, but it's fine. I took a different route in life, and I will be able to kind of build up my pension pot quite quickly. My goal is to get to £85,000 in my pension pot, or in my SIPP. And I'm going to show you what my plan is after it reaches £85,000. So once my pot reaches £85,000, which I'm going to put here as the amount in my SIPP, I am going to assume a 7% yearly interest rate after inflation. So that means a 9 to 10% yearly return before inflation, but 7% is a pretty standard amount to choose. So as you also saw, my target retirement fund is at 2050. So that's when I plan to start withdrawing money from that. And so if I was to meet this SIPP requirement or target number of £85,000 by 2025, for instance, then I would have 25 years of my interest growing, I guess. So I'm going to put 25 years there, and then I'm going to put deposit amount is £0. So basically, if I was to get it to this amount, £85,000, and stop putting any money in, let's see what happens. So you can see that if I was to do that and leave it for 25 years without depositing an extra amount, I could, obviously this is all very speculative, I could get around £486,000 as my final pot number. And that means that I would have earned over £400,000 in interest. So this is quite aligned with the coast approach that I briefly mentioned in my interview with Jennifer, Mama Furfer. I am not necessarily going to do this, but it is an option for me. And I just think it's really interesting, the power of compound interest and the power of time. I don't need a bigger pension pot than that. £486,000 would be a sufficient pension pot size for me. I would aim to withdraw 4% from that on a yearly basis. Now I will also have my ISA, which I will be withdrawing money from as well. So I would be well and truly covered financially. So there are a few things to take into consideration here. As I said, it's not necessarily something that I will do, but it is an option available to me, and it is a path that I am considering, quite deeply considering taking, for a few reasons. One of the first reasons is because I don't want to hit the lifetime allowance, which I forgot to mention in my ISAs versus SIPP video, which a few of my lovely subscribers had commented on, and they are totally right. There is a lifetime allowance for pensions, and there isn't a lifetime allowance for ISAs, which is a pro for ISAs and a con for pensions, SIPPs, whatever you want to call it. So the lifetime allowance is currently set at just over £1 million. Now I know when most people hear that, they're going to think, wow, like that just seems so far out of reach to me, and that seems ridiculous. But it has come to my attention that there are quite a few people who are running this risk of hitting the lifetime allowance. And basically, once you hit this allowance, you will be taxed at 55%. So anything over that allowance gets taxed at 55%, which of course is astronomical and absurd. So one way that you can avoid this is by having both an ISA and a SIPP. So as you saw there, if I stopped contributing to my SIPP once it reached £85,000 and I just kind of let it coast for 25 years, I could potentially have just under £500,000 by the time I retire. So essentially, I would not be nowhere near that lifetime allowance, and it's not something that I would have to worry about. I wouldn't have to pay crazy taxes. But the interesting thing is I would technically overall be close to that million mark if I added up what was in my ISA and also in my SIPP. However, it's kind of smarter to split that between the two so that you don't have to worry about it. So just for a bit of context in terms of what would it require for you to hit the lifetime allowance, you would need to contribute, I've done the calculation, you would need to contribute £40,000 per year into your SIPP or your pension, which is maxing out your pension allowance each year for 16 years with an average return rate of about 7% in order to reach that lifetime allowance. Now, that's not impossible for some people. They are able to max out their pension allowance every single year. And so, of course, if that is you, then you do need to consider some smarter ways of making sure that you don't have to pay crazy taxes. Now, with a lifetime allowance, it does increase with inflation over time. So it's not going to be stagnant as to where it is now. It's going to go up with inflation, but generally speaking, you can kind of look at now in order to get an idea of where it could be in the future. So that is why I'm an advocate and a doer of having both a stocks and shares ISA and a SIPP, because I don't want to max out my SIPP. Another thing to point out is that if I was to stop contributing to my pension each year, then I would no longer get my employer contributions, which is free money, added to my pot. So that's something that I have to weigh up whether I want to do or not, because that free money that I get on a monthly basis would be gone. So essentially I have to think, do I still want to get that free money, or would I rather take my pension contribution and put that towards maybe my ISA or my living expenses or whatever it is? It really will depend on where I'm at in life at that point. Now, of course, all of this is speculation to a certain extent because we really don't know how the stock market is going to perform. So yes, when I use that interest calculator, I'm assuming the stock market will perform at an average of around 9 to 10% every year before inflation. And if it doesn't, then I wouldn't end up with such a big pot. If it underperformed, then my pot would be smaller. But if it overperformed, then my pot would be even larger than that. So I really hope that today's video has been enjoyable, that you've enjoyed seeing my portfolios. Of course, I will be continuing to do this on a monthly basis because I realize people really enjoyed these videos. So again, thank you for watching, and I will see you real soon in the next video. Take care and bye for now.